All right, so hi everybody, this is Chris Raycamp at the UMKC Innovation Center's Tech Venture Studio, and we are doing a little fireside chat on building a data room and best practices in investor communications with Tony Simpson, Lydia Kinkade, and Tristan Mace. Super excited for you three to be here today and to have this conversation. Would you mind kind of jumping in and giving us a little bit of background, each of you, on why you might be a good source of intel in this topic area? And Tony, I'll start with you because you and I were, our conversation is what started it all off.
No problem. Thanks, Chris. I'm Tony Simpson. I am an investor and consultant in the ag tech and animal health and life science generally space, managing director of the forming KC Nexus Fund, as well as founder of AgTech Advisors. It's a consultancy that works with funds that have capital and are looking to deploy it, as well as entrepreneurs that are looking to raise capital and put together a capital raising strategy. Have been in the space and in this industry in Kansas City since about about 2009, actually. So.
Perfect. Thank you, Tony. Lydia, tell us a little bit about your work.
Sure. Hi, everybody. Glad to be here today. I'm the managing director at IIM Innovation in Motion, and we invest in seed to Series A companies across the agriculture, animal health, and human health sectors. We invest throughout the United States and a little bit in Canada as well. Since 2015, we've made 22 investments in 16 portfolio companies. So we've participated in several follow-on rounds with those companies, deployed about $4.5 million at this point. Might close a couple more by the end of the year. We've been really active these past couple of years, expanding our investor base, expanding our portfolio. And I was just really excited about the opportunity to talk about this topic. It's something I think is really important and something that I think, can really help you put your best foot forward when you're getting in front of investors. Being prepared and having a plan for that. So excited to hear what your questions are and dive into the topic a little bit more. Thanks for having me, Chris.
Absolutely. Thank you for being here. And Tristan.
Hey everybody, I'm Tristan Mace. I'm a managing partner at Flyover Capital. We're an early stage, predominantly late seed, early Series A firm. By way of background, I actually had lived in New York City for the last decade, just relocated to Kansas City, which is my wife's hometown. So we decided to move our family. Used to be at Warburg Ceres, which is the sister of Warburg Pincus. There was investing in Web3 technologies on behalf of Merck and AXA, and also do a lot in the venture capital policy space. So work with the White House and the executive branch on some entrepreneurship and venture capital programs, including the Global Entrepreneurship Summit.
Fantastic. So what I'd love to do is I have a list of questions that I'm curious about, but I think as Lydia alluded to, I look at the list of participants, the folks that are in the room. I know there are people here actively raising funds. So I know there are going to be some great questions from the crowd. I'll prime it a little bit just to get us started, but I would love for folks to jump in, whether you want to drop something in the chat or just come off mute and ask a question. I think that is going to get to the meat of the issue quickly. Tony, to prime it a little bit, let's not assume everybody knows what we're talking about here. What's a data room, and strategically, why would you have a data room?
So let me actually start with at least my perspective on how diligence typically works. And this is true for myself and most of the investors I've worked with. Is a VC typically spends the better part of their day in meetings, whether it be verbal, whether it be Zoom now, whether it be on the road at board meetings for portfolio companies. The hours between 9 and 5 tend to be fairly busy, fairly well packed. And what I found, and what I know a lot of other investors find, is the time of diligence usually starts about 5:30 in the afternoon and goes into the evening, or happens on the weekends when you really have time to focus and you're not dealing with that onslaught of demand for your time. And the best story I can tell is, and I've had this happen more times than I care to count. It's 5:30. I want to work another hour or two before I go home. I open a file. I'm going to start digging in and really try to learn more about this company, and there's nothing in it. The three things I've asked for, they've not provided any of them. Something I need to be able to understand this company has never been shared, and now I'm going to either put the file aside and look at somebody else, or I'm going to be annoyed and not be able to work on this opportunity. A data room is a digital way of sharing information. Okay, so think of it as a folder, or and a lot of folks use Dropbox or Google Docs, but it's a way of organizing the documents about your company, information on studies, your cap table, your organizational docs, slide decks, you name it, in a way that an investor can quickly pull it open, look through things, and access information they need to evaluate the opportunity.
That's perfect. And let's go into the components a little bit. Maybe Lydia or Tristan, when you're assessing, you're digging into maybe a great example. You don't have to be specific about a company, but a good example of communication through a data room. What do you want to see in there? Is it a formatting thing, language? Tony alluded to some of the documents or data that should be there.
Yeah, so I mean, of course, every investor has different priorities with what they look for in the data room, but I think it's also safe to say that most of us work from the same baseline, and we have generally the same template that we use for documents that we request. So for us, we have it's a few pages worth of a checklist that we'll send over to the entrepreneur once we're at the point that we're ready to launch diligence, and it's categorized accordingly. So maybe there's like a financial section where we want to see historical financial statements, financial projections as well, and anything else relevant to like that side of the business. Maybe there's an IP and intellectual property section as well. Maybe there's a non-confidential investor section where I can easily pull a pitch deck, executive summary, or maybe something more in-depth that I can share based on which investor wants to see what information. We also want to see a lot of information about the team as well, because that's one of the big pieces of our decision-making process, really analyzing the team, not just seeing their credentials, but able to have like easy access to them as well. And there's other categories as well. You can really you can Google venture capital due diligence checklist and get some really good resources. And it's a blend between like Angel Capital Association and things I've seen from other groups that I liked, and things that have like consistently come up as questions from my group. We see a lot of scientific based companies as well. So a lot of times we'll want to learn more about their regulatory strategy. So it all just kind of depends. But I would say the very best, most efficient way that a data room has been shared with me is one that reflects the same order, like with the same numbers of chapters, if you will, of the data room, exactly how I asked for it, like in that order, in those categories. Maybe it's a Dropbox folder with those file folders named the same way that I do, and all the information in there as well, because then I know exactly where to look for anything that I'm looking for. Past deal documents, oh, they're right here. Current deal terms, right here. Like, I just makes things move a lot faster instead of me having to ask, where is this, where is this, where is this? And I usually give companies, once we decide we're going to launch due diligence, I ask for that turnaround time to be within a couple weeks, because my expectation is that they've already created a data room. If you're out raising money, you really should have a data room already ready to go that you can just fine tune and tailor based on that particular investor. So the best, most prepared, I would say, entrepreneurs turn that around pretty quickly, or maybe they have some clarifying questions. Oh, you asked for this, but we don't have it. Can we provide this instead? Like, it's good to continue to have that dialogue, and then let me know when like everything is populated, so I'm not just left wondering what the status is or whatnot.
Yeah, fantastic. Tristan, is there anything you would add to best practices or things you'd like to see in a data room, or maybe even if you want to spin the other direction, things that as Tony hinted towards, that threw him off and said, all right, I'm done with this for the evening because the thing I need is not here. Anything you would add?
Yeah, I think Lydia said it well, in which that if you're out fundraising, the expectation is that you have a data room. And I find that often times management teams, the founders themselves, it's representative of them, of the level of sophistication and effort that goes into the data room itself. And largely, I find that often embodies what the future relationship may look like with them too. Are they prepared? Do they have the materials that one would typically expect in that data room? If I have some additional subsequent requests of them that may not be represented in there, Are they responsive in feedback and providing that in a couple of days of a reasonable turnaround? Or is it something that is dragged on for several weeks? And I think to Tony's point, there are plentiful amount of deals. And certainly when you get excited about a company, you want to dive into that. You want to feel motivated, and you want to have the reasons why to do that deal and invest in it. And having an ill-prepared data room doesn't give you that motivation. In fact, it oftentimes turns you away from wanting to do something like that. And I'd say the last of which is, and I'm sure we'll further touch on this, but it's imperative to have those documents updated too and reflected to make sure that they're the accurate standpoint. So I'll give you an example in which there's a company, and I'll intentionally obviously leave out the details, but we're very bullish on, we're going to move forward with making an investment. And in one of those, though, the pro forma that they had for the cap table had left off a $100,000 check on it. And so we had ended up, it's a sizable round. And so, from a position standpoint, it's quite minimal effect from an equity position, but nonetheless, it's something where we've had to go back and forth now 2 times from altering our investment in it to accommodate that allocation from the 100K perspective. And so it's just one of those additional headaches that now we're spending additional time and effort that's going into it. The founder's spending additional time and headaches going into it. And now there's additional attorney fees that are going on council side. So it's a waste for everybody there. So I do think that, when you have the data room, make sure that the materials are always up to date and you're being thoughtful about what's in there and ensuring it's accurate.
Chris, if I can, Tristan was very, very nice. When he said that, make sure they're up to date, my first question was, you don't want the 2016 cap table? Every one of us has gotten that. You go in the data room and the cap table is 4 years old. I'm not exactly sure how this helps me. I'm not exactly sure what I'm supposed to do with this. And that gets to something that I kind of want to boil this up a little bit to a level that maybe will help you guys put this in perspective. Investors invest in people, not technologies. Okay. Greatest technology with a crappy management team doesn't raise any capital. Okay. You invest in people you like and want to work with. And Lydia and I have literally had this conversation. Do we want to work with this person? They're making this way too hard. Okay. Everything is a struggle. Every document I request takes 3 weeks to get. I have to ask 2 or 3 times. To Tristan's point, they're not organized. I asked for a cap table. They're not even sure if they have one. It really brings into question the quality of management. On the flip side, when you open a data room and there's more information than you'd ever go through, it's really well organized. They're thinking about this. There's this sense of, wow, this is someone we can work with. This is someone that when we get into this deal and things are bad, they're organized, they're professional. They're somebody I want to work with, as opposed to somebody I'm going to have to drag along through the process. So this is both an issue of diligence, but also an issue of just how do you build a relationship with your investors and how do you get them to like you? Okay. How do you get them to want, hey, I want to take Tristan's call because you know what, he's responsive and thoughtful. I'm probably not going to call Lydia back because I've called her 4 times asking for the same document that she should have been able to send me in 90 seconds.
Yeah. Go ahead, Lydia.
Tristan's right. Tristan's right. I do think it's also indicative of the future relationship. I mean, Tony, you just said it's the start of a relationship. And I've personally seen that play out in our portfolio. Like the companies that it was a tougher due diligence process, slower, not as organized. That's the same like today as when the diligence was completed 4 years ago. So I've had time to see that play out, and it really is true. I agree with Tristan.
That's interesting, and maybe we'll get into this. And the speed of diligence is a pain point for everyone, right? And so that's a point of conversation we could talk about as a mechanism of good relationship building, communication, utilization of the data room. What I want to hit on that you've all touched on is this piece of relationship building in the context of a lot of early founders we work with. So talk to me about good communication from a founder that you might invest in a year from now. So what does it look like to be in that room, to get the warm handoff to someone who is aspirational? Maybe they're not quite to your stage of investment, and how to manage that relationship well. And I'll leave it to whoever might want to jump in there, because that's something that I really commonly get from both sides. The context is, I'll talk to an investor about, hey, have you talked to this entrepreneur? Because I know they're really hungry. And they're like, yeah, I talked to him a year and a half ago or 2 years ago, and I haven't heard from him since. I would love to know what's going on with them. Or likewise, I talked to an entrepreneur and they say, oh yeah, I tried and that went nowhere, right? And so dead end, but should it have really been the end of a relationship, right? And so I'm curious, from anyone, any of the folks' perspective on the panel here, what does it look like to manage that conversation when you're an entrepreneur that's a little earlier than maybe your thesis or your group's going to invest right now?
Even if the company, for us, if it's too early, like when I tell somebody I'd love to see your updates and keep in touch, I do mean that when I say that. And I think what I mean is maybe different for Tony, different for Tristan, different for every investor. What we like to see, like quarterly updates on the company is fine. If there's like an email that gets sent out to all like the current investors and stakeholders, just to keep me in a loop of your progress, or yeah, an email 6 months later. Sometimes we even go ahead and like put a placeholder on our calendars to connect again. It makes things easier when it's the entrepreneur driving that, and they're the ones really taking the initiative to set those meetings and those emails. I mean, and I think the quarterly updates are something every company can be doing anyway, because that keeps you accountable, it keeps your stakeholders informed, and it keeps interested future investors in the loop on what's going on, keeps your company name in front of them as well. So I do like to see that, and I do like to try to help companies even that don't fit into my exact investment thesis as well. I mean, Tony and I talk about this all the time. Maybe there's a company that's too early, so it needs to go somewhere else, or a company not quite in our verticals that maybe could be introduced to somebody else. I know it's hard for entrepreneurs though, to just get told no. You feel like you're hitting up against a wall over and over and over. But you never know who's gonna like make that next great connection for you, or where you might find a big success.
I'd add to it, there's a fine balance between being aggressive and as an entrepreneur, and obviously wanting funding, and certainly as venture capitalists, we understand that, the intention of the relationship. But there really is a balance between also accepting a no and hearing what an investor is saying to you and trying to process and internalize that too. And so when I think about, there are times that we genuinely think fondly of an entrepreneur, but they're too early for us, given a revenue standpoint, customer standpoint, whatever the circumstances may be. And we do want to hear back from them on a regular basis. In fact, what we prefer is to be able to be added to a list that they send out. It may be to their existing investors, it may be separate to other investors they want to keep warm. But what I would share with all the entrepreneurs on this is that just because we may not reply to those and say, good job, keep going, doesn't mean that we're not reading those and taking note and saying, you're making some material progress. This is definitely a company in 3 months, 6 months from now that we'd love to have more face time with and continue to build this relationship. So don't necessarily consider those as silent, or, you know, we sent out 50 of them and we got 2 replies and that means everybody hates our business. It's quite often the opposite of that.
Totally agree. And I'll go as far as saying I had a company that I first met 5 years before I ultimately invested in them. We were interested in the Series A, didn't wind up doing the Series A, but wound up leading the Series B. And it was a matter of a CEO that was very communicative, very responsive, did exactly what Tristan's talking about. Would be at an event and ask to just give me an update, knew that she wasn't raising money right now, but wanted to keep me engaged. And then when she came back around and said, hey, I'm starting to think about my Series B, we were primed and we were ready to look at it. Now, one of the things that I think you have to be able to show if you're going to do these is progress. Okay. And one of the worst things you can get tagged with is we've all seen this. We've all seen this for 3 years and it looks exactly like it did when I saw it 3 years ago, because that deal is now stale and no one wants to look at it anymore. Okay. Other than maybe Friends and maybe old Seinfeld episodes, nobody wants to watch the same thing over and over and over again. Okay. So show some progress, show some activity, be responsive to the questions the investor asked. and be able to show them that traction. And there's another thing that Lydia hinted on that I want to go back to. One of the things that you can do if it's a no is ask who they should be talking to. There have been plenty of companies that I've met that I've referred to others because A, it's not in my space, you're too early, you're too late, you're doing something that I don't, necessarily fund. But you know what? I know Lydia looks at this, and Lydia is some, I'll ask the question, do you know Lydia? Or can I make an introduction? Or, hell, it's happened plenty of times that we'll be talking separately about something and it'll dawn on me, hey, you should talk to these guys, they're interesting. So think about, one of the things that we do to add value within our industry is share deals. Okay. I'm more valuable to Tristan and Lydia because I show them deals they care about, and likewise. Okay. So having a good deal that maybe I can refer to somebody else, even though I don't want to do, is valuable.
That's excellent. Yeah, thank you all very much. And I'm near stepping out of the way here, entrepreneurs. So get your questions ready for these folks. A few things that I heard was that are differing here are the cadence. So I know that there's times when it's too frequent. Lydia, you said specifically kind of quarterly, which is pretty standard. Is there a cadence here that is preferable in terms of maintaining that communication that's respectful, that arrives well for you all?
I think for me, I prefer quarterly broad emails that are these kind of newsletter, and then maybe every 6 month type of personalized outreach. Hey, here's an update, would love your thought on X or Y. And I think Tony alluded to this, which was the engagement factor. If you can get an entrepreneur or an investor who invests slightly later than you currently are at, but you're thinking about that subsequent round, and you can engage them 12 months before, you can get them start thinking about the business, the problem, the solution, how you're going after it. And listen, we understand it's early stage. There's going to be things that don't work. And that's also helpful for us to learn and see the resiliency and how you think about continually solving that problem. And so as many times as it is about how you're taking the approach, it's also, hey, we tried this experiment, this one didn't work out for us, but here's why, and here's what we learned from it. And it's really refined our market, or it's refined our customer profile that we want to go after. And those are things that we look, again, that establish the management team's capacity and their ability to figure this out. Because for early stage, you're betting on the management team more than the product, more than anything. And so we want brilliant individuals who can show that willingness of resiliency, of experimentation, and ultimately making progress for the venture moving forward. So I like to see that hybrid of, some emails I don't feel like I have to directly reply to, but ultimately have some insights in the business, but also ones where I'm happy to lean in and engage a little bit with the founder, knowing that, there's another checkpoint in 6 months from now too.
Absolutely.
The other thing I'd add to that really quickly, Chris, sorry.
Please.
Ask questions. One of the best things you can do, and there's a presumptive close type concept here, okay? And I use this all the time. What would you need to see? So Tristan, I'm pitching to Tristan. I know I'm too early. I know this is not something that they would do today. But Tristan, if I came back 6 months from now, what would you need to see? What are the things that would interest you? What are the accomplishments that would take us from too early to something you would consider? And then come back and report on those. It is very hard to tell you go do these 3 things, I'm interested, and come back 6 months from now with those 3 things and go, yeah, I'm still not interested now. It presumes progress. It presumes a level of interest that allows you to then come back and have a meaningful conversation. Now, it doesn't mean I'm going to invest if you do all those things, but I'm going to invest a lot more interest in what you're doing than I will the person I said, go do these 3 things, and then come back and go, look at these oranges I brought. I didn't ask for oranges. I appreciate that you brought them. I really don't care about the oranges. What about the 3 things I asked? Oh, we didn't do those. We brought oranges. Great. Thanks for the oranges. Appreciate it. Don't care.
If I can add to that, I also want to point out what Tony said is really valuable as an operator of a business, which is if you get feedback, which is, hey, here are the things that you should be doing, but this is still not a fit for us. Really internalize that too and recognize that's a relationship, continue to cultivate. But that goes back into Lydia's point, which is who are other people that investor can help connect you with, right? So I recognize this is not the right fit for you, and you're explicitly stating that and you're reiterating that, but who are other folks that you think could be this if we were to achieve these three things too?
And I will give you an example. I don't even remember the company's name. It's been so long ago. Had exactly that conversation. You guys are way too early. Go do these three things. Come back when you've got them done, and we'll talk. They come back a year later. They'd raised, I think, $250,000. They go talk about all this progress they made. And I said, well, I've asked you 3 questions a year ago. Where are you at on those? Oh, we didn't do those. We did all of these. Okay, that's lovely. You still haven't de-risked this in my mind. You have not moved this fundamentally forward. And now back to Tristan's point, I really have to question your credibility as a management team, because I gave you real feedback as to what would have de-risked this for me. And you ignored that and went off and chased unicorns. Okay, great. Well, hopefully your unicorn farm will do very well. We're not investing in it. So really, now, is every investor going to give you the same feedback? Is it all going to be valuable? Is it all going to be on point? No. But the one thing I will tell you is you're going to find if you talk to enough investors, it starts to kind of converge around a couple of points that are pretty consistent.
Thank you all. I'm gonna pause my questions for a minute and see if we have other folks that want to jump in with specific questions around their ventures, their raises, investor communications, so on. So jump in, folks.
That's a good question. Hi, I'm Quest. So I'm in the middle of fundraising right now for our company. And we love reading into investor theses of how much they'll write their check at and when. Do you suggest tranching year round into stages? So if I know I'm raising 1.4 million, but put it into smaller pieces, so like 300,000 and 700 and raise the rest, or do you suggest just going after the entire check?
I can jump in and give you my perspective on it, Quest. I think in theory it sounds good, but it can get really, really complicated to do that. Like we have done that before with an investment deal that we did where it was tranched financing. The first half came in at a certain valuation. The second half came in at a different valuation, and really things got kind of messy, and it was milestone based. And so like, who is deciding that those milestones have been met and the next tranche is open and that new valuation is in place? So it does get complicated. But on the other side, I think it gave some investors more comfort if they weren't wanting to take as great of a risk in the beginning. They saw these milestones achieved, and then 6 months later they did. So maybe I'm giving you both answers, and that's a terrible way to answer our question.
Yeah.
But it just has to be the right fit for your company and for the investors. You also want to be, I would think you want to be fair for your investors and give the earlier investors who are taking more risk a better deal, at least in some way, shape, or form, because they're taking a risk, like I said.
Yeah.
It can get complicated. I don't know, Tristan, Tony, how often you participated in deals like that? It was complicated for us anyway.
Lester, let me clarify real quick. Are you asking whether you should tranche it as the entrepreneur and raise it in multiple tranches and multiple rounds, or are you asking me if you should raise one round that is tranched?
So if you raise one round that is tranche, so I know I'm going to raise a $1.4 million, but I'm going to tranche into separate pieces. The reason why is when we came out of the accelerator, previous to us getting more traction, it was to say, well, you're early. You don't have as much traction, so raise less. And then as you gain more traction and steam off of that money, value yourself different and then raise more money. And so that's come from a series of investors. But after you pitch to 100+ investors and you get the answer of 30 of them are, we just don't write checks that small. Our minimum check is $500,000. And when we experiment with that on an A/B test and we go back to some of the investors, oh, well, just give me a post. I'm actually interested in that because we can write a check for that. we can get into it. And so that's what we're starting to experience with ours. And it gets a little frustrating at will, but it's the game that we signed up for.
So I have done tranche financings before. Lydia is 1000% right that the problem is we all think the milestones are black and white. And when we get to them, we're at some lovely shade of gray that, yeah, maybe they're met, maybe they're not, maybe they're 80% met. What are we going to do here? It does get messy. It is a way to access the capital and know that you have it available to you. And it does unlock bigger checks potentially. But you know, so my advice on it is to really be thoughtful about who you're doing it with, be thoughtful about how you establish the milestones and what achievement looks like, and be in a position where you can work through, okay, we feel this has been met, we feel this has not been met, and what does that mean? But it's a messier way of doing it. And I know there are a lot of investors that don't like it. They feel like it's kind of dribbling capital in and they'd rather put the whole check in. So I as an entrepreneur, I don't know that I'd offer it. I think I'd offer to raise the whole thing, and we may only, you know, we may raise the entire round now, and we may call it over time, but it's all put in, if you know what I mean. I think I'd rather do that than necessarily consider it tranched and milestone driven. Tristan?
Yeah, I'd echo that too. I mean, I think early stage, it's more difficult to tranche. Obviously, when you go into growth stage, there's unit economics that you can base that far more easily off of. But this early, I feel like it's unnecessary additional segmentation for the point of accessing capital, which I understand inherently as an operator that you need to run the business. But when you're talking about, you know, $1 million and further segmentation there, I'd prefer to see that done over rounds with actionable milestones and a runway that you can demonstrate of, you know, 12 to 18 months ideally. I think that gives credence to past investors. I think that gives better credence to investors coming in terms of their comfort and the probability of success with their capital. I think is important with that too, as opposed to kind of the tranche method.
I did clarify because there's an important point I think that, and I think Tristan just hit on this, and that is, how do you establish your raise? Way too many entrepreneurs figure out what they need to get all the way home and try to raise it all at once. Lydia and I have a favorite company that every time you talk to them, they're going to raise $20 million, and they've never raised $20 million yet in aggregate, let alone in one round. But they're going to raise $20 million every time you talk to them. How do you think about the raise, exactly to Tristan's point? What gives me an appropriate runtime? What gives me the chance to actually create a value inflection and raise the next round? What gives me an appropriate valuation, both for myself and for the investors, and then allows me to grow that? Putting together a raise is not simply as easy as putting together a budget and then saying that's what we're raising. There's an art to it, but doing it right will allow you to retain as much value as you can, create as much value for yourself and for your investors as you can, and then raise capital when it makes sense. Just an aside there, but I think to me, that's one of the things that I see a lot of entrepreneurs do poorly, even experienced entrepreneurs, because raising capital sucks and I don't want to have to do it anymore. And I'd rather just raise it all at once and be done. And they're raising that $20 million round forever. My 2 cents anyway.
Quest, also related to that, one solution that I've seen to be reasonably successful deployed from a number of funds is this idea of writing an angel size check into it to have early exposure, be able to see things. And so it's less about the tranching itself, but you know, some of these funds you're talking to that, you know, they're saying it's too early, but we like where you're directionally headed. You know, that also seems like there's opportunity to be able to say, listen, we'd love for you to invest $50,000 or $100,000 into it. The inverse of that, though, is there's also signaling risk, which is that if they choose not to invest in your subsequent round, there's inherently questions of, well, now they had an inside position on it, didn't do it, and so why not? But understanding that capital is you know, in many respects a requirement for an early stage venture, you have to weigh those and recognize what the value is versus what the risks are.
Thanks for that question, Quest. I appreciate you putting yourself out there. Is there another entrepreneur that has a question for you folks?
Yeah, Brandon Four here. I had a question, wondering if any investors have been a lead on a WeFunder campaign or invested in a company that ultimately did do a WeFunder campaign, and just kind of get your thoughts on that as a fundraising mechanism.
I have not.
I have not either. One of my investors has, and he like helped a company put together their WeFunder campaign. I can't take credit for it, but my investor did that. So, I mean, I bet he would be willing to talk with you if that's something you want to follow up with me directly afterward, maybe to pick his brain and get some insights. I can see if he'd spend some time with you on that.
That'd be great. Thank you, Lydia.
I have not myself, and that's through, I'm involved not only with Flyover Capital, but a venture partner and advisor to a number of other funds, and I don't think any of them have as well. I think one of the complexities there is you look for a cap table that's going to be additive to the management team, and so when you think about such small checks, which on aggregate are certainly helpful from an operational standpoint, but you really look for people who are bought in, people and entities who are bought in, who are going to be able to reasonably and be motivated to provide that type of guidance to an early stage management team. And I feel like with a lot of these different funding platforms, that is often missed. There's an entrepreneur I'm close with. He's raised $8 million from Republic and a handful of others. He has one of the leading companies that's raised the most capital from them. And he's facing that crunch right now with raising another round, which is just, he had all this capital, but he doesn't have institutional dollars who've come in that round. And so now he's kind of starting from ground zero. He had 8 million to prove off of, which is great. And he's done well with it. But nonetheless, it's still really difficult because now he's starting to try to create those relationships that otherwise, or early investors would have seen in that previous round of how he and the management team had navigated their challenges.
One of the other things I'd add, Brandon, is most investors in the, even maybe beyond the seed stage, but certainly in the Series A stage, do not like to go it alone. Okay, and there are two reasons. Okay, number one, if we're the only one that sees the opportunity here, why are we suddenly smarter than everybody else? What do we see that no one else sees? Most investors are not that myopic that they think we figured this out. Nobody else is as smart as we are. We got this cornered. Okay. We want somebody else, we want Tristan or Lydia standing next to us going, no, you guys have got this right. This is cool. But secondly, and more importantly, we want somebody else with deep pockets so that when the trouble hits, there's somebody to stand next to us and go, hey, Tristan, we all need to kick in a little bit more money to get these guys to the next proof point. With a crowdfunded campaign, you better prove it on the money you have, because to Tristan's point, there's nothing behind it. So these folks have no obligation to put any more capital in. They're not going to support the next round. You are starting at square one. And so if you don't make it to the point where the next round of capital is throwing itself at you, you don't have people that are incented to help you raise that additional round of capital. I don't know, Tristan, Lydia, I don't know if you feel the same way, but that's always been a challenge of mine.
Yeah, and you want to have a strong board, and usually like institutional professional investors can bring that to the table and create tons of value for you as well. And Tony's right about having deep pockets, or maybe Tristan, sorry if it was you said that. Like we've invested, I think, in 4 bridge rounds in the last 12 months for our companies that just really needed, 6 more months of runway or 8 more months of runway because stuff has happened this year, right? And so we were able to provide that type of support along with the other major investors in the deal. And I would think you probably can't get that from a WeFunder campaign. So just don't count on it as like your end all be all.
And it also speaks. Go ahead, Tony.
I'm just going to ask a quick question. Have either of you guys ever had a company that didn't need a bridge round?
A handful,
like
but
they won't.
Yeah, right. But it's also, I think in all seriousness, it's predicated on the relationships that you forge, right? And understanding those challenging times are inevitably going to happen, and having the honest dialogue and being involved with that company and understanding the pitfalls or why they've, endured such a challenge, whether that's market timing or a customer is delayed for, 3 months of signing an agreement because of management changes, whatever that may be. But those are the types of things where you want somebody who is motivated, incented to participate and provide that bridge and saying, listen, we understand where you're directionally going. We're still big fans of this. And we recognize instead of going out to the market and raising at a, or not being able to raise at a detrimental or down round, here's a way that the economics can work for everybody and the company can continue along in its journey.
Thank you, Brandon, for asking that question. That took us in an interesting direction for sure.
Yeah, great answers.
Anybody else want to step up and ask a question? We probably we have about 11 minutes here. Want to be respectful of everyone's time. So depending on how long-winded we get with this one, it could be one, could be two more questions.
So I do have one more question. Hopefully it's a short one. It goes back to what I guess Tony was talking about on preparing for your raise. So if I know that hypothetically I need $588,000 for 12 months of survival to go all in for this, and all of fund investors are saying raise for 15, 18, 22, 24, one of those. So we're at a 900 million and 4, depending on which terms you go with. Should I be out here raising for, like you said, the 24 months or 22 months? Or since it's an art form, could I be shooting ourselves in the foot? Should we be raising more or should we be raising less? Since it is technically our second round after you claim an accelerator as a round.
So I'll dive in and what I will tell you is that it somewhat depends on the personality and the approach of investors as a general rule. Okay, and this is a generalization, which means it's wrong some of the time. Most investors want to see 18 to 24 months. And the math of that is not overly sophisticated. It's simply, we think the next round is going to take you 9 months to a year to raise. And so we want you to have at least some significant amount of time focused on the business. And if you raise a year of capital, one of the things that invariably happens, I told the story, oh, you raised a year of capital, great. When you're done celebrating this evening, let's meet tomorrow and we can start talking about raising the next round because you're already behind, okay? So having that additional runway is a good thing. Quest, I would also argue that the axiom of everything takes twice as long and costs twice as much as you plan is probably no more true than any place than it is in venture capital. Everybody needs more money and everybody takes longer. So having a little bit more runway gives you a little bit of a cushion. If you don't need it and you're able to drive revenue and you're able to drive that next great transaction, then it gives you fuel to either do the next thing or grow the platform or to continue to have some flexibility. At least that's my perspective and my approach. Lydia and Tristan may feel differently.
Yeah, I agree with Tony for sure. And what I see often is a range from companies that they're trying to raise. And the minimum though can still get them like 18 to 24 months of runway because 12 months goes by so fast and you're not going to get 12 months out of the money, like Tony was just saying as well. But they'll have like a minimum that they need to get them to that 18 to 24 months, but then also a maximum. And they say like, well, if we get this maximum, we could really accelerate and really move fast and really hire this like extra person or two and have this huge sales force or whatever. So it's nice to see that I like being able to see like different plans, like either way within that range and what would happen. Cause yeah, you're just going to be out fundraising forever if you don't plan for enough time.
Yeah, I think the only thing that I'd add to that, which is it's largely milestone based too, right? So I like to see 18 months, but it's also predicated on what those KPIs are that are universally agreed for, largely speaking, for that next round too. And so, that plays into it. So if you're talking about a potential commercial agreement that you think may take 6 or 9 months that you need to have not only executed against, but then you need to have actualized numbers off of that for a demonstrable another 6 months. Well, hold up now, and now you've got the fundraising process. So suddenly you're at 24 months off of that, where originally you thought you may be on safe to go on the 15 to 18 month side. So I think a lot of it's dependent on the milestones that you have kind of agreed to of the use of funds. And I think to Lydia's point, I'm slightly different in which I don't necessarily like to see a range. I like to know explicitly what you're asking for and what you expect to be able to accomplish with it. But I will couch that with, I often like to say, if we were to do an extra $500,000 or $1 million on top of this and increase the round size, what would you do with that? Right? And where would that get you beyond runway and saying, well, suddenly we're at 30 months or so forth? Like, what would that get you? And those KPIs, how do you accelerate faster towards those, or the higher viability that those inevitably come true? And those are things that I do like to understand, the founder's mentality, not necessarily that we're going to do it, but where are those levers that he or she thinks that they're able to pull? And that gives a lot of insights into the business too and operations.
Quest, one
Thank you
last
so
point
much.
to build on what Tristan was saying, and he's absolutely spot on. One of the things a lot of entrepreneurs don't appreciate is investors will actually do their own models, and they'll come up with their own cash flow, and they'll come up with their own number. And almost universally, the answer is you're not raising enough. We think, you're at 588. We think you ought to be at 850. And this is why. It's less about the number you put out there and more about the thought process and where you think it gets you. And to Tristan's point, what are the additional levers? And so, I know I will do my own model. I will come back and look at what I think the needs are. I will be more conservative than you are, even though you're going to tell me your models are conservative. I will be more conservative than you are. I will also probably look at what the downside is. And then I will do the same things Tristan talked about. What's, if we put another 300,000 in, how far does that get us? What are the milestones? What are the time? And I'll bring all of those variables together to try to come up with a number that I and the other participants in the round think makes sense.
Helps a lot more. Thank you.
Yeah, thank you all. We're coming up, there's 5 minutes left here. So maybe I'll just prompt Lydia, Tony, and Tristan, if there's any, parting words here. We kind of went from, data room, investor comms, over to some raising strategy, different kinds of rounds. Is there any little tidbit of wisdom or something lingering you'd love to say to the group before we sign off here?
Ladies first.
I mean, I think this conversation has been great. I think all your questions have been really insightful and thoughtful, and I appreciate Tristan and Tony. You guys, I agree with all the things you're saying. Something else that I would just add is to have a good attorney. Draft really good documents, because you can get yourself in a lot of trouble. I don't mean just getting sued. I mean, like, get yourself in so deep with messy documents that investors just don't want to mess with it. So that comes into play with your capitalization table, with your corporation documents, even small friends and family fundraising rounds can really wreck the opportunity for future investors if they're not structured and written properly. So just I would recommend to keep that in mind when you're out fundraising, to have a good attorney, good solid documents drafted for you. That's what I got.
Tony, go ahead.
My advice to you is twofold. Number one, and I always use the analogy that fundraising and going through the diligence process is kind of like dating. Okay. And the more I've used it, the more it proves true. Okay. And the one thing that I like to say from the very beginning is, if it's really, really hard in this process where we're trying to invest in you and you should be on your best behavior, that is a very big key of what it's going to be like after we write the check. And I don't want any part of that. So really understand how you're interacting with an investor, making it a positive experience, and demonstrating your credibility and your professionalism. That's number one. Number two, and this is one I don't think we do enough coaching on, and that is, don't go into this solely thinking about how can you sell Tristan or Lydia or I in writing a check in your business. Do your diligence on us. Understand who we are as an investor, understand how we operate. Talk to portfolio companies, talk to people we've done diligence on in past, talk to co-investors, get to know who you're investing in. Just because somebody offers you a term sheet or offers you a check doesn't mean you should take it. Okay. There is bad money. Okay. And bad money doesn't mean bad people, doesn't mean, that the funds are fraudulent. It could mean that there's a bad alignment. Okay. Great example. I'm in the last year of my investment period. I'm going to start harvesting next year. you need 9 years of runway before you get out. I shouldn't invest, and I should know that as an investor, but you sure as hell shouldn't take my check, okay? Because we've got a giant mismatch and we are both going to be really unhappy. So do your homework, ask good questions, really get to understand what you're getting into and the partnership you're making, just as you would in a relationship, any relationship.
Yeah, to echo lastly on Lydia's point around the legal counsel, that pro forma example that I mentioned regarding the cap table, it ultimately was the legal counsel's fault actually for having missed that. And the founding team ended up providing evidence of that from the legal counsel who said, yeah, we admitted it, that was our fault. You know, one could argue from management team whether they should have, you know, been able to know that explicitly, but all of that to be said, that it matters on this. And it was kind of one of those things where, you know, we've got to get past and move forward with. But I think that the relationship that you develop with investors is meaningful, whether they invest or they don't invest. It's representative of the collective market, how they talk about you as a founder, how they talk about your company, what you're doing. And that oftentimes matters when you're looking at a current round or positioning for a next round of what the market thinks about you as you chatting with, you know, Tony and Lydia at a party and talking and say, oh, they're about to raise. And you hear one of them say, you know, they've kind of blown me off. I haven't heard from them and there were supposed to be some follow-ups. That brings up those questions. And you don't want to necessarily have any of those questions lingering out on. So I think all of that is meaningful. And lastly, in regards to general communication with your existing investors, you know, those people in those company or those entities themselves, they've taken a big bet, and they take an early bet that's fraught with a lot of risk. And I think the best thing that you can do is, you know, be honest, be transparent with them, talk. And, you know, it's easy to hear from them in the good times, and they're quick to want to email in those. And then you can oftentimes find more from silence from founders and recognize that that's not necessarily a good thing all of this time. There's a fine balance there between hearing from one and not hearing from one. But nonetheless, good luck and kind of your respective journeys with this. And, you know, I think having that type of relationship is important.
Well, I really appreciate all this wisdom here and you all being willing to take the time, Tristan, Lydia, and Tony, to dig in a little bit on your experience and open the shades a little bit into the investor point of view, right? It can be challenging to have that perspective. As part of Digital Sandbox, we see a lot of early founders, and we, you know, that grant funding is predicated on folks that are on the trajectory to eventually raise capital. And so we're really typically working with early founders that are interested in this. So it helps us a ton to have folks like yourself being willing to have the conversation and kind of extend, help us extend those folks into your world a little bit as they're going to raise rounds. So thank you, all three of you, so much for being here. And thank you to the founders as well for taking the time. Wish you all a happy holidays. We will have some more events. Delvin, I saw your chat. Casey Invested, as part of the UMKC Innovation Center, does do small group investor and entrepreneur virtual coffees, and I hope someday back in person. And I know many of you participated, so if you're interested in that, please just reach out to me directly, and I'll get you in there, and we'll continue the conversation. But thank you all again for being here, and have a wonderful evening and holidays.
Thanks, everybody.
Thanks, Chris. Thanks,
Thanks,
everyone.
guys.
Thank you, guys.
Thank you.
Bye.
Appreciate it. Good stuff.
Everyone.